Silver is flashing an overheat signal, and that usually means the next move is down first, even if the big trend is still up. That sentence will make two groups angry at the same time, and that is exactly why it needs to be said out loud. The first group is the people who buy every green candle because they think momentum is a guarantee. They do not want to hear the word pullback. They want confirmation. The second group is the people who see one red candle and start screaming rigged, as if every drop is proof the market is fake. They do not want to hear the word overheated. They want a villain. But silver does not care about either group. Silver does what it always does when it gets stretched. It resets. And the cruel part is, when it resets right after the most bullish headlines, right after everyone finally agrees, right after the chart. It looks like it cannot possibly go down again. That is when it hurts the most. So if you are holding silver or watching silver or trying to build a position without getting emotionally wrecked, this is the episode that saves you from the most common mistake in this metal. The mistake is believing the next move must follow the last move. Silver does not move like that. Silver moves in phases. And the most dangerous phase is the phase where the market feels strongest. If you want calm, mechanism-based analysis like this, subscribe. This channel is built for people who want to survive the cycle, not just cheer for it. And share this with one friend who buys every dip automatically and one friend who screams manipulation on every dump, because both of them are going to get tested in the same way and they both need the same map. Now let me open with a scene you have probably lived through. Silver starts to run. It feels clean. Every dip gets bought instantly. People who ignored it for months suddenly notice the talk turns from maybe to definitely. The comments turn from cautious to certain. Charts get posted with straight lines and big targets. Everyone starts speaking like a winner. Then the market does something violent. Not a gentle pullback, a slam, a red candle that feels like it arrived from another universe. It breaks the level everyone was watching. It triggers stops. It forces margin calls. It turns confidence into panic in minutes. And the most confusing part is what happens right after. Sometimes it bounces hard, like the dump never happened. Sometimes it keeps bleeding, slowly, quietly, like a leak after a burst pipe. Either way, a huge number of people get trapped emotionally. They either chase and get hit, or they panic sell and watch it rebound, or they freeze and swear they will never touch silver again. That cycle is why silver has a reputation. Not because silver is cursed, because silver is structurally built to punish certainty. So let us define what we mean by an overheat signal, because this is not a prophecy and it is not fear. Overheated does not mean the bull market is dead. Overheated means the market is stretched far above its recent normal. It means prices move too far too fast. It means participation has become crowded. It means leverage has likely increased. It means the system becomes fragile. Fragile is the key word. A fragile market does not need bad news to fall. A fragile market falls because the smallest push triggers a chain reaction. So if you want to understand why the next move can be down first, you have to understand the three forces that create crash-style drops in silver. The first force is leverage. Leverage is not just a futures trader with a big position. Leverage is a mindset that spreads through the market. When silver starts running, people stop sizing like adults. They size like it is a once-in-a-lifetime move. They borrow. They use margin. They buy options. They concentrate. They take what was a normal position and make it a bet that must work now. That behavior creates a market that is easy to knock over, because leverage turns a normal pullback into forced selling. The second force is liquidity. Liquidity sounds like a boring word until you realize it is the difference between a controlled pullback and a waterfall. When everyone leans bullish at the same time, the order book gets thin in the wrong places. The bid looks strong until it is needed. Then it disappears. Then price gaps. Then the gap triggers stops. Then stops trigger more selling. Then selling triggers margin calls. Then margin calls trigger liquidation. Liquidity is the floor. When the floor is thin, the market drops through it. The third force is mechanics. This is the part people refuse to accept because it feels unfair. A lot of selling during a silver dump is not someone choosing to sell because they changed their mind. It is someone being forced to sell because their broker changed the rules, because volatility rose, because margin requirements increased, because risk limits were hit, because a fund had to cut exposure, because a dealer hedged aggressively, because a portfolio Mechanics does not care about your thesis. Mechanics is a machine. So a crash-style drop in silver is often not a discovery. It is a release valve. It is the market draining leverage and restoring balance by hurting the crowd. And silver is uniquely prone to this because silver is thin, emotional, and reflexive. Now let us talk about the pattern, because silver repeats patterns the way weather repeats seasons. First, the rally accelerates. The dips get bought instantly. Confidence becomes absolute. People stop using the word if, then a sharp dip hits, and it gets bought. That moment is important because it teaches the crowd the wrong lesson. It teaches them that every dip is free money, then the next dip hits deeper. It breaks a level, stops get triggered. The selling gets faster. The dip buyers hesitate. Then the cascade begins. It feels like the market is targeting people personally because it breaks the exact level everyone was watching, and it breaks it fast. Then, eventually, the selling exhausts itself. Not because the market suddenly becomes kind, but because forced sellers run out of inventory and the price finds a level where buyers with patience finally step in. That is when you get the violent bounce. That leaves everyone confused. Now the market chooses one of two paths. Either it builds a base and recovers, which is the healthy reset path, or it continues to drift lower, which is the regime break risk path. That is the fork. And the whole goal of this episode is to give you a way to tell which fork you are approaching without pretending you can predict the exact day of the dump. Because the point is not to predict the crash. The point is to stop being ambushed by the phase of the cycle Silva is famous for. So here is the crash dashboard. This is the set of dials that tells you what you are actually watching. The first dial is stretch. How far has price moved away from its recent baseline? Not from a 10-year baseline, from the behavior the market has lived in recently. A market can be bullish and still be stretched. Stretch is about speed and distance, not about the long-term story. When stretch is extreme, the market becomes vulnerable. It does not guarantee a dump, but it raises the odds that the next surprise will be down. The second dial is leverage and crowding. Is the market crowded? Is the positioning heavy? Is volatility rising? Are the moves becoming sharper? Does it feel like everyone is on the same side? A crowded market can continue higher for a while, but it becomes fragile. The higher it goes while crowded, the more painful the unwind tends to be. The third dial is the tape behavior. Does the market start gapping? Do intraday swings widen? Do rallies become more vertical? Do pullbacks become sharper? When the tape starts acting like a knife fight, it is often a warning that leverage is building and liquidity is thinning. The fourth dial is the one that keeps you grounded: immediacy, not the spot chart immediacy. Physical tightness signals staying stubborn, or are they relaxing? Because here is the twist that saves you from the biggest misread. A silver dump can be bullish. A silver dump can be a reset inside a tight system. If physical tightness remains stubborn while the paper price flushes, that often means the market is draining leverage while the underlying demand and supply friction remains. That is when the dump is more likely a purge, not a death. If physical tightness relaxes quickly while the paper price flushes, that often means the market is cooling, not only in paper, but also in the real world lanes. That is when the dump is more likely a sentiment unwind with less structural support underneath. This is why the dashboard matters. It turns panic into diagnosis. Now I want you to feel how this changes your behavior. Without a dashboard, you see a red candle and you react like a human. You feel betrayed. You feel fear. You feel rage. You feel the urge to do something now. With a dashboard, you see a red candle and you ask the right questions. Is this a liquidation cascade, or is this a fundamental shift? Is the market dumping because it is fragile, or dumping because the underlying tightness is gone? Is this a reset, or is this a break? And those are not philosophical questions. They are questions you can answer by watching how the dials behave after the first shock, because the first shock is always the same. The difference is what happens next. Now let us talk about why this overheat phase is so dangerous psychologically. Because the overheat phase is when the market gives you the most reinforcing feedback. Every dip gets bought. Every warning gets mocked. Every cautious person feels stupid. Every aggressive person feels smart. That reinforcement trains the crowd to take more risk. And then when the market finally resets, the crowd is overextended. That is why the dump feels so violent. It is not only the price move, it is the collapse of the crowd's confidence structure. This is why you see the same comments every time. It was going to the moon and then they slammed it. I got stopped out and then it reversed. I bought the dip and it kept dipping. This market is rigged. I'm done with silver. These are not unique experiences. They are the normal outputs of a thin, leveraged market that runs in phases. So if you want to be better than the crowd, you do not try to eliminate the phases. You adapt to them. When the market is stretched, you manage risk first. When the market is flushing, you watch for exhaustion and you watch whether immediacy stays expensive. When the market stabilizes, you watch whether it can hold a base and rebuild. That is how you survive. Now, let me give you one more truth that will keep you calm. In silver, the most bullish long-term environments often contain the most brutal short-term dumps because a bullish environment attracts attention. Attention attracts leverage. Leverage creates fragility. Fragility demands purges look like crashes. So you can be right about the big picture and still get wrecked by the path. This is why the goal is not just being right. The goal is staying alive. Now, before we move into the next part of the story, I want to lock in the key lesson of this first chunk. An overheat signal is not a prediction of doom. It is a warning that the market is fragile. Fragility means the next surprise is often down. In silver, The drop is often mechanical. It is often leverage and liquidity and margin dynamics, not a sudden discovery that silver is worthless. And the way you tell a healthy reset from a regime break is by watching whether the system stays tight or becomes loose after the flush, because silver can dump and still be tight. Silver can dump and become loose. Those are two different worlds, and if you cannot tell the difference, you will keep reacting emotionally to moves that are actually diagnosable. So in the next chunk, we are going to walk through the crash sequence the way a professional would. We are going to talk about the exact moment the dip stops being a dip and becomes a cascade, what exhaustion looks like, why the bounce can be violent, and how to tell whether the bounce is just a dead cat or the start of a new base. And once you see that, you will stop being surprised by the most dangerous phase of the silver cycle, because you will finally recognize it while it is forming, not after it breaks you. The moment you can recognize it while it is forming, you stop taking the crash personally. Because a silver reset is not a moral judgment. It is not the market punishing you for believing. It is the market doing what fragile markets do when they get stretched. So now let us walk the sequence like a professional would, because this is the part that turns fear into pattern recognition. A reset almost always starts with a lie. The lie is that everything is fine. Price pulls back a little, and the crowd buys it instantly. The bounce is sharp. The recovery is fast. People point at the bounce and say, see, every dip is free money. That is the first lie. Because the first dip being bought does not mean the market is healthy. It can mean the market is still crowded, still euphoric, and still training itself to take more risk. Then the market gives you the second lie. It makes the next pullback look like the same thing. It breaks a minor level, it shakes people out, and then it bounces again. It gives the crowd another reinforcement cycle. This is how overheat turns into fragility. The market is teaching the crowd to do the same thing at the worst possible time. Now comes the moment where the dip stops being a dip. This is the moment you have to understand, because it is the moment that separates a normal pullback from a cascade. A cascade begins when three things happen close together. The bounce becomes weaker. The sell-off becomes faster. And the level that everyone was watching breaks in a way that does not allow clean exits. When the bounce becomes weaker, it tells you the dip buyers are running out of confidence, or out you have case, or out of margin. When the sell-off becomes faster, it tells you the market is moving from choice selling into forced selling. And when the level breaks without clean exits, it tells you liquidity is thinning right where everyone thought the floor was strongest. That is when the trapdoor opens. And this is why the crash always feels like it came out of nowhere, because the warning signs do not look dramatic. They look like small changes in behavior. A little less bounce, a little more speed down, a little more slippage, a little more hesitation. Then sadly, everyone is trying to get through the same door. Now, here's the single most useful thing you can do during that moment, and it has nothing to do with prediction. You do not ask, why is this happening? You ask, is this mechanical? Because mechanical selling has a very specific feel. It is fast. It is relentless. It is indifferent to good news. It does not care about support levels. It does not care about headlines. It cares about clearing positions. And when the selling is mechanical, you often see a strange phenomenon. The market becomes irrationally one-directional, and then it becomes irrationally... In other words, the dump is violent, and then the bounce is violent. That is not the market changing its mind. That is the market exhausting forced sellers, then snapping back when the pressure is gone. This is why silver bounces can look like miracles. They are not miracles. They are the removal of a mechanical weight. Now let us talk about exhaustion, because this is the part people misread the most. Exhaustion does not feel calm. Exhaustion can feel like maximum panic. It can feel like the final wave where everyone gives up. It can feel like a last plunge that looks like the market is breaking completely. Then it stops. Not slowly. It stops like something hit a wall. And that is when you often get the bounce that leaves people furious, because it bounces right after they sold in fear, or right after they got stopped out, or right after they swore they were done. So how do you tell whether that bounce is meaningful? You do not do it by staring at the bounce. You do it by returning to the dashboard. You check whether this was a reset inside tightness or a reset inside loosening conditions. And you can tell by watching what happens in the real world lanes, and by watching whether the market can build a base after the first rebound. Here is the key difference. A healthy reset bounce is not just a bounce. It is a bounce that gets followed by stabilization. It is a bounce that stops making new lows quickly. It is a bounce that creates a range, a place where the market starts trading both sides instead of dumping in a straight line. It is a bounce that, even if it pulls back again, does not immediately collapse through the same low. A weak bounce is different. A weak bounce is sharp, but it fails. It cannot hold. It rolls over quickly. It makes lower highs. It starts bleeding again after the excitement of the rebound fades. And the most important tell is that buyers stop showing up on dips. In a healthy reset, dips are bought not because the market is euphoric again, but because value-focused buyers step in after leverage is cleared. In a weak bounce, dips are sold because confidence is gone and the market is still unwinding. Now let us bring immediacy back into the story, because this is the dial that keeps you from being fooled by the chart. During a paper flush, Physical tightness can either stay stubborn or relax. If physical tightness stays stubborn, it suggests the underlying friction is still there. The system is still charging rent for certainty. That often means the flush is a purge of leverage more than a collapse of demand. If physical tightness relaxes quickly, it suggests something else. It suggests the demand pressure is easing into lanes that matter, or supply is becoming easier, or the urgency is faded. That makes it harder to argue that the flush is purely a purge inside a tight system. This is why two silver dumps can look identical on a chart and still be completely different events underneath. And if you treat every dump as the same, you will keep making the same mistake. You will either panic sell a purge that was actually the reset you needed, or you will buy aggressively into a break that is actually the start of a longer unwind. Now, here is the hard truth about how to use this information. This dashboard is not a magic shield. It does not eliminate risk. It makes risk legible. It replaces surprise with probability, and that is enough to change everything, because silver destroys people through surprise. Now let us talk about the most controversial part of this episode, the part where people will comment, "You are trying to scare people out of silver." No, I am trying to stop people from getting forced out of silver at the worst moment, because the difference between a long-term winner and a long-term victim in silver is often not conviction. It is execution. It is whether you respect the phase. It is whether you recognize when the market is fragile. It is whether you avoid being maximally exposed at maximum stretch. Because here is the thing most people do, and it is the thing silver punishes the hardest. They add risk when they feel best. They add size when the chart is clean. They add leverage when the narrative is loud. They go all in when the market is already overheated. Then they are shocked when the reset arrives. But the reset is not a black swan in silver. It is a feature. So the smartest way to use the overheat signal is not to flee. It is to manage exposure so you are not forced, because forced is the enemy. Forced means you do not get to choose your exit. Forced means you become part of the mechanical selling. Forced means you hand the market your position at the worst price because you ran out of margin, patience, or emotional control. So if you take one practical lesson from this episode, take this. Avoid being forced. Everything else becomes survivable if you avoid being forced. Now let me paint the full reset timeline in a way you can recognize without charts. At the top of an overheat phase, you feel like time is accelerating. People are talking about silver again. Every conversation becomes bullish. Every dip feels like an opportunity you cannot miss. Then the first crack appears, a sharp dip. It scares people, it gets bought, everyone relaxes. Then the second crack appears, a deeper dip. It scares people more. It gets bought, but with less force. Then a day comes when the dip does not get bought fast enough. The bounce hesitates. The market grinds lower instead of snapping back. That hesitation is deadly because it gives the crowd time to realize they are crowded. Then the level breaks. And once it breaks, the selling is no longer about ideas. It is about exits, stops trigger, volatility spikes, liquidity thins, margin pressure rises. And then silver does what silver does. It flushes fast enough that nobody feels like they got a fair exit. That is why people call it rigged. Then when the selling is exhausted, it snaps back. And the snapback is violent enough that it feels insulting. Now the market is in its most important phase, the base building phase. This is where you find out what kind of event it was. If the market can build a base, it was likely a purge. If the market cannot build a base, it may be a deeper unwind, and you do not have to guess. You watch whether the market holds higher lows, whether dips continue to find buyers, whether volatility begins to calm, and whether immediacy stays stubborn or relaxes. Now, we should address the counter case, because it is real. Sometimes the market is not just overheated, sometimes the world changes. Sometimes macro conditions shift. Sometimes risk appetite breaks. Sometimes the dollar strengthens and liquidity drains. Sometimes industrial expectations weaken. Sometimes the environment that supported the move stops supporting it. In those cases, a dump is not just a purge. It can be a regime change. So it tells you the difference. A purge is violent, and then it stays. A regime change is violent, and then it stays weak. A purge clears leverage, and then the market can breathe again. A regime change clears leverage, and then the market cannot recover because the underlying bid is fading. So if you see a flush, and then you see rebounds failing repeatedly, and you see tightness signals easing, and you see the market losing the ability to hold bases, that is when you stop calling it a reset and start treating it as a deeper shift. That is not fear. That is diagnosis. Now, I want to give you a simple action plan that matches each phase, because this is how you stop being emotionally reactive. When the market is overheated, your job is risk management, not prediction. You respect stretch. You respect fragility. You do not assume the next move must be up. You avoid building a position that requires perfect timing. When the market starts cracking, your job is observation. You do not immediately declare collapse or victory. You watch whether dips are being bought with the same urgency. You watch whether the tape is getting sharper. You watch whether the market is starting to behave like a knife fight. When the cascade hits, your job is patience. You let forced selling reveal itself. You do not panic based on the first wave. You watch for exhaustion, and you watch for whether the system stays tight or becomes loose. When the bounce arrives, your job is not to celebrate. It is to see whether a base forms, because the bounce is easy, the base is the truth. Now, let me say something that will make the silver permeables uncomfortable, but it is necessary. A healthy silver bull market needs resets. Resets are not a betrayal. Resets are how the market clears weak hands, clears leverage, and builds a stronger foundation for the next move. The market cannot go vertical forever. When it tries, it breaks. So if you believe in the long-term story, you should not fear the reset. You should fear being positioned in a way that the reset forces you out, because the market does not punish belief. It punishes fragility. Now let us close this with a final synthesis that you can carry into the next week, the next month, the next surge. Silver is most dangerous when it feels easiest. Silver is most dangerous when everyone agrees. Silver is most dangerous when the chart looks like a staircase, because that is when leverage is highest and liquidity is thinnest. An overheat signal does not mean sell everything. It means the market is fragile and the next surprise is often down. Crash style drops are usually mechanical. Leverage, liquidity, margin, risk off, forced selling. And the way you tell a healthy reset from a regime break is by watching whether the system stays tight or becomes loose after the flush, and whether the market can build a base instead of bleeding. If you can do that, you stop being a victim of silver's most famous phase. You become a reader of it. Now, if you want the next episodes in this series, subscribe, because we are going to take this crash dashboard and apply it to real recent moves in silver so you can see exactly how the dials behaved before, during, and after the flush. And share this with a friend who buys every green candle, because this episode might save them from learning the same lesson the expensive way. And now I want the comments, because this is the most useful debate you can have if it stays grounded. When silver dumps hard, do you treat it as manipulation or leverage? Or both? What is the single signal you personally trust to tell you the flush is near exhaustion? And when the bounce comes, what tells you it is building a base instead of setting up a second leg down? Because the people who survive silver are not the people who predict perfectly. They are the people who understand the phase, manage fragility, and refuse to be forced.